All right, let's talk about life insurance. We all kind of know it's important, but man, it often feels so complicated. Is it just protection, or is it supposed to be an investment? Well, that's the million-dollar question, isn't it? And today, we're actually going to answer it. We're putting two very different types of life insurance head-to-head to see where the smart money really goes.
So let's just get right to the heart of it, okay? Let's start with the one question that really matters. If you weren't around tomorrow, what would happen? Yeah, it's a tough thing to think about, I know, but it's the entire reason we're even having this conversation. It's all about protecting the people we love from a financial nightmare during what would already be the worst time of their lives. You know, at its core, life insurance is a really simple promise. The deal is, you pay a little bit over time, and in return, an insurance company promises to give a big lump sum of money, tax-free, to your family if you're no longer there. It's a safety net that keeps the mortgage paid, helps with college, and just covers all those day-to-day bills when your income suddenly vanishes.
Okay, so you've decided you need that safety net. Awesome. But now you're faced with a choice, and honestly, this is where things get confusing for a lot of people. The good news is, there are really only two main kinds of life insurance, but they work in completely different ways.
The easiest way to think about it is like this. Term life is like renting an apartment. You get simple, affordable protection for a specific amount of time, like the 20 or 30 years you're paying off your house and raising your kids. Permanent life, on the other hand, is a lot more like buying a house. It costs way more, it's meant to last your entire life, and it comes bundled with this investment-like feature called cash value.
So the whole argument for term life is just about being smart and strategic. Why pay for more than you actually need? With term, you're buying pure, no-frills protection just for the years it matters most, when your debts are high and your kids depend on you. It is by far the most cost-effective way to get a huge safety net. And that convertibility thing? That's just a great backup plan in case your situation changes down the road.
Now, on the other side of the coin, permanent life does have some attractive features, I'll give it that. The coverage never ends, which sounds great, and that cash value thing we talked about. It grows without you paying taxes on it every year, and you can even take out loans against it. These features are often sold as these powerful tools for building wealth, and they can be useful for very wealthy people with complex estate tax issues. But for everybody else, the question is, are they really worth that much higher price tag?
Okay, so that brings us to the main event, the showdown. Enough with the theory, right? Let's get into the actual numbers, because this is where the difference between these two paths becomes, well, impossible to ignore.
So to make this super concrete, our sources lay out a perfect example for us. We've got a healthy 30-year-old woman, she doesn't smoke, and she wants a $1 million policy to make sure her family is totally protected. Let's see what each option is going to cost her.
First up, the simple 20-year term policy. Get this, for a full $1 million of protection, her cost for the entire year is just $480. That's $40 a month. You probably spend more than that on coffee or streaming services, right? It's clean, it's simple, and it's shockingly affordable.
Okay, now, brace yourself. For the exact same person, for the exact same $1 million death benefit, what does the permanent policy cost? The premium absolutely skyrockets to over $9,600 a year. Just let that sink in for a second. We're talking over 20 times more expensive. It's not even in the same ballpark.
And this, right here, is the million-dollar question. What could you do with all that extra cash? I mean, after paying for her term policy, our 30-year-old still has almost $9,000 left over every single year, compared to the permanent option. So what happens if she just takes that difference and invests it for herself?
All right, let's fast forward 20 years. Let's say she chose that expensive permanent policy. The guaranteed cash value, that's the investment part she's been paying all that extra money for, is sitting at about $181,000. Got it? Okay, keep that number in your head.
But what if she went with path B? She bought the cheap term policy and invested the difference herself. Well, assuming a pretty standard 8% average return from the stock market over those 20 years, her own investment account would have over $421,000. I mean, that's more than double the cash value in the insurance policy. This, folks, is the power of buy term and invest the difference right in front of your eyes.
And when you dig into the numbers on that permanent policy, it gets even more interesting. Just look at how long it takes you to get your own money back. Look here at year 10. You've paid in over $93,000 in premiums, but your cash value is only sitting at about $65,000. You're deep in the red. It takes almost 2 decades just to break even. Think of all that lost opportunity.
And I know what you might be thinking. Yeah, but the stock market isn't guaranteed. And you're right, it's not. So let's be super, super conservative here. What if she just took that difference and stuck it in a basic savings account earning a measly 1% interest? Even then, After 20 years, she'd have over $196,000. That's still more than the permanent policy's guaranteed value. Even in the absolute worst-case investment scenario, you still come out ahead.
So, after looking at the hard data, the picture is pretty clear, right? For the overwhelming majority of people, one of these paths just makes a whole lot more financial sense than the other.
Look, the verdict is pretty much in. Life insurance should be about one thing: protection, not a complicated, expensive investment. The problem is, these permanent policies are often bundling insurance with a really high-fee, low-return investment. And honestly, it usually benefits the person selling it way more than it benefits you. Buying a cheap term policy does the main job, protecting your family, while freeing up thousands a year that you can put to work way more effectively in your own investment accounts.
And hey, this isn't just me saying this. The financial experts behind our sources say it directly. For the average person, obtaining term life insurance and investing the difference can prove to be a better financial option. At the end of the day, separating your insurance from your investments is really the key takeaway.
Okay, so we've covered the why. It's crystal clear. Now let's switch gears and talk about the how. If you've decided that, yeah, getting this protection is the right move for you, what are the actual steps? What do you do next?
The whole process is actually pretty straightforward, way less scary than it sounds. First, you fill out an application with your basic info. Then, for most policies, you'll do a simple medical exam. A lot of times, a nurse just comes right to your house to check your blood pressure and take a quick blood sample. After that, the insurance company's team, called Underwriters, reviews everything. And finally, based on all that, they'll come back and make you an offer with your specific price.
And here's the best part, you are totally in the driver's seat when it comes to how much you pay. Every single healthy choice you make, from quitting smoking to even just improving your driving record, can directly save you money. But honestly, the two biggest game changers? Choose term over permanent and always shop around. Get multiple quotes.
And one last thing, and this is super important. You have to be honest on your application. It might be tempting to fudge a few details to try and get a lower price, but just don't do it. If the company finds out you lied, they have the right to cancel your policy, or even worse, deny the payout when your family needs it the most. It's just not worth the risk, period.
So, we've broken it all down, right? We've looked at the types, we've crunched the numbers, and we've laid out the action plan. The only question left is the one that actually matters. What are you going to do with this information? What's one small step you can take, maybe even this week, to make sure your family's future is secure?